This morning, let's first tackle the mega cap names. Really, they're down today, but seen as sort of the value tech this year when the higher growth names are selling off.
Yeah, we didn't participate a whole lot in that real go-go tech. Our largest holdings, the valuations aren't stretched. Even the recent quarterly earnings, for the most part, outside of Facebook, were outstanding. The offset on Facebook is they're hoovering up every share they possibly can with multi-billion-dollar buybacks. So we're really comfortable with our top positions right now.
David, payments names also make up a significant part of your portfolio. I see PayPal and Visa. Do you think that their sort of valuations have been beaten down enough, or do you think that they continue to see fundamental disruption in the space from incumbent fintechs, the crypto space, what's going on in Europe with peer-to-peer payments?
Yeah, there's some hair on these stocks, and the prices reflect that. We've owned Visa for years, and it not long ago it was a pretty large holding. We've actually were trimmers over the last year or so, but we're back in buying again, and we're slowly rebuilding our position. Same can be said for PayPal. PayPal was more unique than Visa in that the valuation really got ahead of itself, and so it's been hit so hard that if this continues, we probably need to start building up that position again. But we like the long-term secular story. We recognize some of the disruption that's going on in the payment space. We think these companies are going to be able to handle it. And we're going to let the valuations come to us if we want to build more from here.
David, we're talking about a lot about what's not working this morning, the high growth, Zoom, some of the payments. But, S&P and NASDAQ are still really, really close to all-time highs, and that can't be all, kind of mega-scale tech. What is working the way you look at the markets and your holdings, and why?
Well, again, when I look at some of the better stocks that have performed outside of tech in our portfolio, and just on a real short-term basis, just looking at the screen today on what's green and what's, red's getting hit hard in tech. I mean, we only own 20 stocks, but a little diversification goes a long way. We own Bookings, we own Progressive, we own United Healthcare. All of those have terrific long-term fundamental stories. We understand the business models. The valuations aren't demanding, and the stocks are reacting in kind. In the large cap growth area, which is very crowded, they're under-owned. And so, as your previous guest mentioned, some of the stuff that's under-owned is picking up a bid these days.
What is a valuation that's not demanding at this point?
In terms of in the tech sector or non-tech?
Tech sector. I don't know how you're measuring PE or however you want to chart that out.
Well, I think a name that is less demanding, and it should be on investors' radar screens if they don't own it, is Taiwan Semiconductor. An unbelievably terrific business. We learned something very interesting in their recent quarterly filing. Taiwan Semi's bookings grew over 40%, and that was twice their headline revenue growth. They took in, and they've never had anything like this before, they took in $4 billion in prepayments from the likes of NVIDIA, AMD, Apple. I mean, these companies are begging them, please take our money, please give us your cutting-edge technology, please put us at the front of the line. The stock's going to probably earn $5 next year. It's 12, 13 times EBITDA. It's 24 times earnings per share. And they've scaled, their margins continue to expand, or their profitability. I mean, here's a business, mid-teen grower. It's got a cash flow return on investment exceeding now 40%. 24 times isn't a screaming buy, but in this environment, it's time to start building positions in that. And that's what we've been doing with TSM.